Welcome to our YouTube video where we will be discussing the slow employment costs reported in the fourth quarter of 2022, and what this could mean for the future of the Federal Reserve. In the fourth quarter of 2022, the Employment Cost Index, a barometer the Federal Reserve watches closely for inflation signs, increased 1%, a bit below than the expected 1.1%. This was the lowest quarterly gains in a year, and even wages and salaries for the period only rose 1%. The cost of benefits increased to just 0.8%. This news comes the same day as the Federal Open Market Committee begins their two-day policy meeting, and this could encourage the FOMC to approve a 0.25 percentage point rate hike at least. The greater focus will be on what the officials signal about the future of monetary policy. Markets are anticipating one more quarter-point hike in March, followed by a pause and then one or two cuts before the end of the year. However, the Fed officials have been reluctant to any policy easing in 2023, though they could change their minds if inflation readings continue to abate. To that end, analysts at Capital Economics suggest that a further slowdown in wage growth over the coming months could convince officials to pause the tightening cycle. The next big data point we will be looking at is the Labor Department's monthly non-farm payrolls report, which is set to be released this Friday. Analysts are expecting that payrolls will increase by 187,000 in January, with average hourly earnings increasing 0.3% monthly and 4.3% year over year. In conclusion, the slow employment costs and moderate wage growth are likely to encourage the FOMC to keep raising interest rates in the near future, but the projections for an easing of monetary policy could heavily depend on the upcoming Labor Department non-farm payrolls report and any further inflation readings. We'll keep an eye on these developments and provide updates as information becomes available. Thanks for watching and check out our other videos for more news.